We're live. Welcome, folks. Welcome to Monday Night Futures Live. Ah, okay. So, how do I unembarrass myself yet again? Thank you all for the heads up. I don't know if my cheeks are red. They don't look that bad, but sorry about that. Thanks for the heads up, guys. So, happy Martin Luther King Day. I hope everybody had an awesome day. I'm a big fan of his, and the man was worthy of a holiday. And hope everybody enjoyed their day off. Okay, so we had the futures that were open today. Bitcoin was obviously trading. Bitcoin's taken it on the nose since the IPO of those ETFs, but it's no great shock. It was buy the rumor, sell the news. That's the way it goes. So the futures markets are open now. We're going to go to those in a moment. What we're also going to talk about is something that's going to seem very, very redundant. And the topic is going to be the yield curve. Folks, I know I spoke about it on Thursday. I know I speak about it on a consistent basis, but there's a reason for it. The steepening of the yield curve has proven over the past, I don't know, few generations to be extremely bearish for the equity markets, whether you trade in the S&P 500 or the small caps. It doesn't matter. They're going to get annihilated at some point in time down the road. Is it tomorrow? I don't know. Is it next week? Is it this year? I don't know. We're not that smart. All we are able to do in this business is to take little pieces of information like a jigsaw puzzle, put them together and say, okay, compared to the history of these events, what is the most likely outcome for the equity markets? What are these hints, these clues telling us? That's what technical analysis is all about. So it's not just technical analysis, using the charts as one component and using the macroeconomic data and then putting them together. So we're going to talk about that tonight in great detail yet again, because a big thing happened last week on the yield curve. Stick around. It's important. And it's not good for equities. And we're going to talk at the end how I plan on positioning moving forward. So if you're not currently a member, subscribe to the 14-day free trial offer. Not ready yet, at least subscribe to the YouTube channel. I finally started doing shorts today. I got a lot of views on shorts. I was shocked. So I plan on doing those more, getting a lot more content out there. That was one of my commitments for 2024. A lot more is coming in the new year. So before I forget to share my screen, let's first bring up comments. Thanks, guys, for the no audio. Audio's good. Thank you, Seymour Rivers. Larry, no rally until March. That's the way it feels. Okay, it's understandable. I mean, the daily charts of the Qs, the daily charts of the S&P 500 appear as though we may be getting ready to put in a double top. It's a daily chart. That's only a short-term double top. It's not a weekly chart, but take a step back and take a look at weekly charts. You could argue that we had a peak back in 2021, 2022, early 22, and then we're putting in a double top there as well. That argument can be made, but that is a real macro 100,000 foot view of the battlefield. And if we get a double top on a weekly chart and a breakdown to new lower lows, that's a serious meltdown in the equity markets. So we can't rule it out. So Larry, you may have a valid point. We want to be open-minded. We don't want to be overly bearish. We don't want to be overly bullish, because if you get too directional at any one given time and you don't have the capital to back up your position in case you get trouble, that's usually when you're wrong. So we have a lot of capital right now in my retirement account, 50% cash. I'm trying to maintain 50% net liquidity. We're less than that now in the trading account where we trade our options. And that's going to change this week because we'll be closing out Boeing, which is tying up a lot of capital. So more to come. It's going to be a busy week, folks. We're going to be rebalancing this week. So members, stay tuned. Okay. I have a white one thing. Let me share my screen. The futures markets are open. Talon. Hey, brother. Happy MLK Day. And I will be playing a couple of very brief videos. So we want to have that share audio on, and we are good to go. All right. I'm sipping my chamomile tea, because if I would have had coffee, I would not be able to sleep tonight. Okay, so we're looking at the Dow Jones Industrial Average, and we're down fractionally. I mean, really nothing really to write home here about. I want to take a quick peek at the daily chart for a moment to get a vibe for how we closed out. Of course, one of the futures were open today. Maybe the U.S. equity futures were closed. Gold was definitely trading. Maybe the U.S. futures were closed. So let's go back to use a 2-minute. 2-minute chart. So we have a move lower here. Is this a dead cat bounce? Do we break to new lower lows? Let's set an alert. And even if we put in a new lower low, I mean, this is a 2-minute chart, not a big deal. Taking a look at the E-minis, and this is for the S&P 500. They're down spot 10%. They gap lower at the open, dead cat bounce. Let's set up an alert here. I think that we are going to break these lows. Taking a look at where are my Russell 2000 small caps. They're actually up. I don't think we need an alert here. Now, I do have a position on the Russell 2000. We have what you call a strangle. That's an option strategy, a cash flow strategy on the small caps using the TNA. That's a leveraged ETF. And we may be closing that out this week. I'm probably closing out a lot this week, reestablishing better risk-reward timeframes. Let's take a look at, did we do NQ? We did not do NQ. NQ, this is your triple Qs, but in the futures. And again, a gap lower. Here we will set an alert. It looks like we're going to break now. So the equity markets are not doing much right now. Let's face it, they're by and large flat. Now, the VIX, we want to pull back here, get a look at the VIX from a higher level view. Now, let's clear all this off. Daily view. So we have on the VIX a wedge pattern forming. The reason why I would deem this as being bearish for equities is that what we did is we put in a low back on December the 14th. And on that low, we consolidated and then we gapped up higher here on the 20th of December, went into correction, and we're putting in a higher low from this December low. So there's a strong possibility, not a strong probability, a strong possibility that we get a breakout here. And so I'm going to want to know about that. Because there's going to come a point where we want to raise capital. So in this market environment right now, I'm not looking to put, as a matter of fact, this was a question posed on one of the shorts I published, whether or not it was time to go putting money to work in the long term in the equity market. And my answer was, it depends upon your age, number one. If you're 20 years old, just start dollar cost averaging in and you'll be fine. If you're older and you're in wealth preservation mode, then no, the answer is no. You don't want to put new capital to work for the long term. Equities are very, very expensive right now. So okay. All right, so we have alerts set to let us know that, okay, we trigger this once. All right, let's just keep an eye on the VIX. We trigger it twice. All of a sudden, that becomes a trend. So we have a close eye on the VIX, which is, of course, up right now with the equity markets down, or especially the E-minis, which should be trading inversely of down. Let's check in with yields. We're back down with a free handle on the 10-year, which should be pretty bullish for equities. Now, if we see a pullback on the 10-year yield, especially with the Federal Reserve probably going to cut rates in March, then if we see a yield that drops down below 3.5%, what's wrong with the economy? Hello? I have a question. What's wrong with the economy? Why are yields dropping like a rock? Because you don't want to see that. That's a sign of a weak economy, not a strong economy. Taking a look at the U.S. greenback. Sorry about that noise. I'm glad Thinkorswim changed that noise. It's not as rude. All right, the dollar is looking pretty good here. I got to tell you, on a daily time frame, similar as to what we saw with the VIX, we're putting in higher highs. Now, why might that be? We're going to go into that in a moment. But my guess is that if my thesis is accurate as to why the dollar is up right now, then gold should be up as well. And it is. So gold is up at 2,059. So what gives here? What's going on that you have gold and you have the US dollar up at the same time when generally they trade inversely of one another? In short, geopolitical risk. Light sweet crude, I think we're going up on light sweet crude. Again, geopolitical risk. Now, taking a look at the daily chart here of oil, here's a double bottom. Let's clear all this up, start anew. Here's your higher lows. Here's your pivot point right at, what was the high here? High of 76.18 the barrel. So if we get a rally up and through that mark, well, you're going to want to take a look at the energy stocks. Let's create an alert here, because as goes light sweet crude, if it goes up, so goes inflation. Okay. So W formation in the making. No guarantees we're going to break out, but it's looking pretty good. Now, Nat Gas. I think somebody just mentioned something about Nat Gas. Oh yeah, Larry. UNG, interesting chart. Can we buy it on this? I'm entertaining it. Today, Nat Gas took it on the chin. It was down lower. Last I looked, it had come slightly off of the lows. But I mean, wow, what a drop today. It's still down 6%. Let's go to a 5-minute chart. And they're already starting to rally it back here a little bit. So would I want to buy UNG? Would I want to buy Boyle? No, probably not. That doesn't mean I wouldn't sell premium. I would sell perhaps either puts or a put spread and just generate the cash flow that way. Maybe even open up Iron Condor, something like that. You know, natural gas is just so volatile, especially when you're using a product like Boyle, which is a leveraged ETF, to trade it. You know, you really need to have insurance policies on the wings of that trade. So I wouldn't go. I would probably sell an Iron Condor and trade it that way, and just you're not going to make as much money due to the fact you have the insurance policy on there. But let's face it, I had the insurance policy on Boeing, and that really saved the day a week ago today. So we did close out that Boeing trade, reestablished though, and it's going to expire before earnings. So we're going to be looking to close out the trade because they took no time decay out on Friday with a 3-day weekend. So they're probably going to kill premium tomorrow. So we'll look to book profits and reestablish in something else. Maybe we'll trade earnings as long as there's a high IV rank, but we're going to be very, very conservative with earnings trades. We haven't done them the past few quarters, but I'm probably going to retest the waters yet again with different strategies. So again, if you're not currently a member, sign up 14-day free trial offer. You get those alerts. And I provide you my trade execution so you see the structure of the trade. That's why I provide the execution, so you can see exactly what we're doing. Paul, hello, sir. Mr. Pete, welcome. Okay, moving on with the futures action. We did gold. Let's take a look at SI, silver. Silver's up as well. Looks like the geopolitical headwinds are helping the silver markets. Pulling in here a little bit, though. Copper. Now, copper was looking good the last time I looked at this chart, but it's since fallen apart. So, you know, this was a breakout that failed. So you want to avoid copper right now. Now, this is not a good sign. If you're looking at indicators for global growth, the last thing you want to see is copper breaking down after having a failed breakout. So this is not bullish at all. You know, if we recapture, 390, I guess the ounce, or I don't know how they trade, how copper trades, but if we capture support at 390, then maybe they'll salvage the breakout. We have yet to break down to new lower lows, but this is certainly a breakdown that I would not buy the dip on. I would rather see it rally back, recapture support, and pay up a little bit for the probabilities of being right. You buy here now, you're kind of hoping when you should fear. Moving on to, we did not gas, we did gold, we did not go over agriculture. Now, agriculture has been getting walloped. I think corn prices hit 3-year lows today. This is a weekly chart, and as you can clearly see, at a bare minimum, this goes back to February of 22. We are clearly at the lows. And when you take a look at soybeans, soybeans appear ready to probably take out the lows of November of 22. So is this a sign of deflation? Well, with food, perhaps. I'm sorry about that noise. I can't shut it off. With food, perhaps. Wheat is firming up here. Let's put a alert up here. That's right. Okay. I don't think the ETF, WEAT, I don't think that trades anymore. Somebody, if you want to correct me on that, please do. I want to make sure I'm factually accurate. But I don't think that it does. So those are our futures actions, folks. So I don't think we could, it's a holiday, right? So I don't think we could draw a lot from this. There's not a lot of volume here. I'm going to go over a chart in a moment. It's going to show the margin debt, how much is out there right now. So let's get to it. We might as well just jump right into it. And let's begin with economic data coming out this week. Tomorrow, we're going to get the Empire State Manufacturing Survey. We had the Chicago survey, which came out, I think it was last week or the week before. Not good. Wednesday, import prices. This is an important number. So the United States generally exports inflation, but we import deflation. So we're going to want to see how import prices are doing. The dollar has been fairly strong of late. I'm not predicting a very, very serious hot number here for the U.S. economy, but if it does come out hot, that's going to be a problem because we don't build much stuff here anymore. We import a lot. So you don't want to see prices on imports go zooming up higher. Retail sales, big number coming out on Wednesday. We're going to talk about the consumer a little bit. I'm not going to be the least bit surprised to see retail sales beat. That's a tease. Stick around. Industrial production, important number. Capacity utilization, important number. Business inventories. Are we growing inventories? If we are, that means people aren't buying, and that means retailers are going to have to cut prices. Thursday, Philly Fed manufacturing survey, housing starts, building permits. They're a forward-looking indicator. So you need to take out a building permit. Well, you're going to start probably 6 months down the road after you get approved. They don't have to break ground, but it's an indicator. If you see building permits dry up, that's a major problem for the home builders. Wednesday, consumer sentiment, preliminary, important number. This is the first read, not a revision. And we have a couple of Fed heads coming out. Existing home sales should be interesting. It looks like inventories of existing homes are on the rise. So we may see some pressure on housing prices. The question is, do we get a reprieve from rents? That's what's driving up inflation right now. Moving on to the valuation. This is rear view mirror stuff, meaning this is a trailing PE of 32.2 on the S&P 500. If you take a look at the forward-looking multiple, whether it's by design or not, they are taking down their EPS guidance, making stocks more expensive. So there's a way to look at this, and that could be, well, you have analysts that are reducing their figures so that way companies can beat, and that way they get the stock market to rally. That's the game they generally play. So I wouldn't be the least bit surprised to see them be doing that. If they're right, though, and these companies miss on guidance, well, then that's a problem because we're already very expensive. And we could see equities take a real body blow in the coming weeks. So this is going to be a fairly muted week. We have more big banks coming out this week. Not much in terms of earnings on the agenda. The week after, it starts to heat up. And the week after that, that's when I think you get the big mega tech stocks that really come out. Perhaps it's the week after next. I'm not quite sure yet, but soon. They're going to be coming out hot and heavy. Now, already the banks are not looking good in terms of technical analysis, and we'll be looking to short JP Morgan. I did a video on this over the weekend, and it's posted on YouTube, best stock charts for the new trading week. So members are going to do more of a deep dive on that trade. We're going to be looking to short JP Morgan. We've done it twice already profitably. We're going to look to do it again now that earnings are out of the way. Okay, so we have margin debt, which is not bad. Honestly, there's enough margin debt out there to really fuel this market up higher. So it's not as though we are as overbought as we were back here in 21, January of 21, February of 21. Then you had I believe that was the Russian invasion, and then you saw a risk-off environment. So margin debt can move up higher, driving equity prices up higher. We can't rule it out. Again, there's a lot of doom and gloom that I'm going to be talking about tonight. That doesn't mean equities are going to collapse. There's always Uncle Jay that they look towards to cut rates and to save the day. And right now, it looks as though he's going to save the day like he's always done. They're projecting it, and Jay Powell, Uncle Jay, never disappoints the markets. That's what you need to understand. Forget about the pontificating of these analysts on CNBC. It doesn't matter. It doesn't matter. We have as much information as they do. We're going to be talking about it in a moment. One of my alerts fired off here. What was that? NQ, that's the NASDAQ 100, just broke that support level. That was only a 2-minute chart. So we're not going to read too much into this. No drama. Let's go to a 5-minute view. Okay, so now the NQ is down spot 11%, still not a major drop here. What I always look at when I see a breakdown to new lower lows, I'm always looking to see how much follow through you get behind it. Because a lot of times you have stop losses built back here, and they take it down below that support level. They may bid it back. Oh, wow, they just, whoa, somebody just started selling here. Look at the volume. It's some buying there, to be fair. A little bit of a battle here. Okay. Looks like the bulls are coming in. All right. So there's not a lot of volume behind this, and there are buyers out there willing to bid up the market. So we're not seeing a major follow through. Looks like the stops were taken out here. Oh, there we go. We're now down 0.14%. Let's just stick with this for a moment. 1-minute chart. We're going to rally here in a minute. I don't know where we have support right now, but I would be a buyer, at least for a scalp, to the long side right now. Were we at support? I don't know if we have a support level on here or not. All right, so we just had the E minis and the Dow futures break to new session lower lows. Again, those are on 2-minute charts. We just saw some buyers step in here. Okay. So we covered margin debt. That could still fuel the market. So we have the demons of Davos meeting again. It seemed like only yesterday they graced us with their presence over with their Lear jets over in Switzerland. They produce every day what our carbon footprint is for a year with those jets, yet they're going to tell us how to live our lives. And trust me, they're not eating chemical meat right now. They're eating the good stuff. Wagyu. So what's on the agenda this year? What do they have in store for us? Okay. Well, first of all, I think we ought to begin with the positive. And the positive is this. They want to focus on rebuilding trust. Now, that's great. You know, I think they've finally come around. At least I thought that for a moment until I found out the other topic on the agenda was Disease X. That's now trending. There was actually a Senate bill that passed in December dealing with Disease X. What do they know? All right, so looks like they have something surprise for us. We're going to have a heck of a October surprise this year with the elections in front of us. We'll talk about that in a moment. But the demons of Davos never failing to give us a false sense of security, wanting to rebuild our trust while trying to kill us, to be frank with you, with their Disease X. And of course, their cure. If the disease doesn't get you, the cure sure as heck will. So thank you for being there, you demons, you Bond villain demons, you. Now, I always like to hear from them and what they have to say. So here's this one coconut. I don't know who he is, and I believe this may not be this year's. It could be last year's because I seem to recall this. But you know what? It's always good to hear it straight from their mouth. Because one thing about these guys, they tell you what they're going to do because they're very confident, and they've been right.
We're developing, through technology, an ability for consumers to measure their own carbon footprint. What does that mean? That's where are they traveling? How are they traveling? What are they eating? What are they consuming on the platform? So, individual carbon footprint tracker. Stay tuned. We don't have it operational yet, but this is something that we're working on.
Now, I don't know about you, but I know through all the business courses I've taken in my life, every great business was founded on solving a problem and providing a solution to that problem, and there is the demand for the solution to that problem. I challenge anybody to find a person next to them that is looking for a tracker to find out what their footprint is, and so they can be monitored, what they eat, what they buy, where they travel to. What this is, for all intents and purposes, is the climate change grift, which is ripping off trillions of dollars out of our pockets. The worst thing in their minds is an awakening by the public. They need to be able to monitor you so that you can't go after them. That is why they need this. It's all about control. They've made their money already. I don't know if this guy's a billionaire, but the guys that are in charge of the World Economic Forum, they've already made their money. They have no use for money anymore, with the exception of the fact that they're maintaining their lifestyle and give it to their kids. But what they want to do is play God. That is the narcissism that we're dealing with here. Now, what's on the agenda this year with the old beacons of light over in the Davos? Well, you have top 10 risks that they're concerned about. If they're concerned about them, I'm concerned about them because I'm invested in these guys. I'm invested in their success. So 2 years, what are they concerned about? Misinformation and disinformation. Translation, freedom of speech. Sunlight is the best disinfectant. Freedom of speech provides that. They do not want freedom of speech. That's what you're hearing about security of the internet. It's basically just make sure you know who's on the internet, what they're saying, and cancel them out if you're able to. Extreme weather events. Well, you got to have that. That's number 2. I would think that extreme weather events would be greater than misinformation, unless, of course, the misinformation is a threat to your global hoax. And that would be an impact on the pocketbook. They can't have that. So, okay, so I understand now why freedom of speech is a greater threat to them than extreme weather events, even though extreme weather events is life or death. Societal polarization. Now, this is an irony. They're the ones who created the polarity in the society to begin with. Divide the people, get them arguing amongst themselves so they don't look at what you're doing. That's classic Marxism. That's classic. So I'm not sure why that's on this unless they want a virtue signal. Okay, we'll give it to them for that reason. Cybersecurity. Well, we've already had Klaus Schwab, the leader of the World Economic Forum, he's already come out and said there's going to be a mass cyber event. I don't know how he knows this, but he's telling us it's coming. Scores God made green little apples. It's coming. So, okay, interstate armed conflict. Now, this is a global society. So when they say state, they're not referring to Iowa, Texas. They're talking about nation states. So they're looking at all the polarity that they've caused, and now they're wondering whether or not there's going to be a clash. I don't really think they care a lick about it. They're all about eugenics, the depopulation. So if anything, it's good for them, unless, of course, it's the interstate armed conflict coming after them. Then that's a problem because they can't have that. Lack of economic opportunity. Well, they're killing the middle class with inflation. So I'm not sure why that's on there. Not quite sure. Inflation. Okay. Involuntary migration. That I think is towards the 15-minute cities. Any migration I see right now seems pretty voluntary, honestly. Economic downturn and pollution. I'm not even going to go to 10-year view. All right, so this is what's on the mind of the so-called elites. I like to call them parasites because they need you to feed off of. So on a lighter note, nations are rising up. You're not seeing it here in the United States as much. Well, you're in a way you are, but you're not seeing it vis-a-vis protests. In Poland, you have a new socialist prime minister that was elected there, immediately arrested his predecessor. Now, because of all the protests, he's promising to pardon them. So hundreds of thousands of people protesting over in Poland against the installed leadership by who else? The World Economic Forum. The Dutch. This has been going on for over a year now. They had elections. I don't know if it's done any good. The Dutch farmers are having their farms taken from them. So the big globalist organizations, Monsanto, Cargill, they can come in with their corporation farms and do what they did here. And GMOs, meaning genetically modified foods, all that crap, pesticides they put in our foods, they want to provide that to the Europeans, which have far better food quality, especially in Italy, than we do here in the United States. Here in the United States, it's absolutely disgusting what we're given to consider as food. Anytime now. X. France. Violent protests emerging. And the pimp Mac Daddy of them all is over in Germany. Thousands upon thousands upon thousands of farmers with their tractors. Yeah, the truckers that joined in on the convoy. Look at this. Amazing. So people are waking up. What are they trying to do there? They're raising the diesel taxes, basically to put the farmers out of business. So that way, the Monsantos of the world, the Cargills of the world, they can move in there, take up those farms, and then the state is in control of the food supply. That's what they want. Now, you would think that the gray lady, the paper of record, would be reporting on all of these events. Here's the front page of the New York Times, and you're not going to find anything here about the European uprisings. Nothing. And you may be saying, Bob, why don't you drill down to the world? Stop focusing in on the front page. Okay, let's do that. Nothing. There's nothing here. Look at these protests. There isn't a word about this on the New York Times. Nothing. This is the country that we live in right now. Let's drill down to Europe. I haven't checked this. I did check world. Let's drill down to Europe. This is Europe. Nothing. Think about it. They don't want this optimism, this pushback against this globalist agenda being sold here, being reported here in the United States, because it's infectious. They need to keep us fighting. Now, isn't it ironic, the very day that the World Economic Forum kicks off, it's the day of the Iowa caucuses, and at last check, Donald Trump was about 28 points ahead of, what's her name, Nikki Haley. The Democrats, you know who's dumping money into her campaign now? The Democrats. Because they know if Biden runs, there's no way he's going to win. Even if they cheat, there's no way he's going to win. So they need Nikki Haley, controlled opposition. So now we start segueing over and into the problems that we have geopolitically. And I think I've been one of the leading voices on this ever since day one of the first attack on a ship in the Red Sea. I spoke about it. I said, don't worry about it. But if this becomes a trend, this is going to become a major, major problem. And Qatar pauses LNG shipments in the Red Sea after U.S. bombs Houthis. Fast forward to, I believe this is either yesterday or today. Why am I out of sequence here? I'm out of sequence. You had a ship that was sunk in the Red Sea. I don't know why I don't have this up here. I must have closed it out. My apologies. But you had a ship go down in the Red Sea. So this event here is only growing worse. And what it is it's driving up shipping rates. What is that? That is inflationary. So why are you seeing oil prices stabilize now? Weekly chart, it's been really consolidating nicely. If there's an event over in the Straits of Hormuz, we spoke about this on Thursday night. If there's an event over there, that's right here. Look out below for this market, because you're going to see oil skyrocketing up and through $100 a barrel. That is recession. Sure as God made green little apples. So this is a valid view of what we're looking at right now. The stock market looks very, very good. Does it look a little bit tired on a daily chart? A little bit, yeah. We didn't start the year off strong. However, it does appear that we can move up higher, but the bones on which this stock market is built upon is exactly like the structure you have here. It's a train wreck. It's really, really bad. And we have no leadership. There is only a plan to continue to put pressure on those that provide, those that produce. They need those tax dollars to keep the spending going. It's a party in Washington, D.C. Neither party wants to stop it. All right, so headline, this is off of the Wall Street Journal. This is actually old news, but it's now being reported on yet again. It's over Powell's Wall Street Journal mouthpiece, and JP Morgan confirmed imminent end of QT. What is that? That is the runoff of the Federal Reserve's balance sheet. That balance sheet rose last week. Now, we haven't really seen consecutive rises in that balance sheet in quite a while. Usually it's just 1 week up and then we drop down again. So we're going to be looking very closely when we go live on Thursday night this week. If you're not subscribed to the channel, please do so. Get alerted when we go live. So we'll check on the Fed's balance sheet. We'll see whether or not we have week over week rises in the Fed's balance sheet. Is that bullish or bearish for equities? It is bullish. Why? Cheap money. Cheap money. Liquidity. Now, on the inverse of that, you had Fed's Mester says March is probably too early for a rate cut. Bollocks, as our British brethren would say, bollocks. No, no. I don't care what Mester says. I love Liz Young. She's usually spot on. She's over at SoFi, I believe. Yeah, SoFi. Trying to push back on a March cut. More Fed speakers coming in the next few days. Barkin later today. Kashkari tomorrow. Waller on Tuesday. They may try to jawbone expectations down. Folks, all you need to do is take a look at this one simple tool. And I'll share it with you because always remember, Jay Powell never disappoints the expectations of market participants. So what the expectation is here is that there is a 73.3% probability of a ease in March. Now, that's been a little bit higher. It's come down a little bit, but in all probability, they are going in March. We'll keep a close eye on this, but as of right now, I wouldn't worry a lick about the Federal Reserve not cutting rates. Now, if this changes, we drop down below 50%, that's a different story. May, we are at 100% probability of a rate cut. Is this bullish or bearish? It's both. It's both. What does that mean? Well, for the Federal Reserve to cut rates, think about where we are right now in this rate cycle. We're about average of where we should be. Rates are almost at normal. You know, still on a historic basis, you could argue that we're still pretty low. But we have so much debt. The consumer has so much debt. The federal government has so much debt. They can't afford the interest payments. That's why you can't have a 4.5 handle on the 10-year yield before the stock market goes, whoa. The debt. It's always the debt. And does Washington understand that they are the proximate cause of inflation? Yeah, they understand it, but they don't care. They're good. They're good. They have their insider stock deals. They're good. They're all millionaires. They go in, most of them not millionaires. They're making what, $174,000 a year plus expenses. They leave millionaires. What's that all about? So as it stands right now, in terms of what does it mean for the markets, the Federal Reserve is going to need a reason to cut rates. Usually what that means is that at the first rate cut, the equity markets may go up, but then they go right down. And they go down pretty hard because the Federal Reserve is responding to something. Something has happened. Either it's geopolitical, it's impacting the U.S. economy, or they're expecting it to, or it's economic here, a bank is blown up. Something needs to get addressed because the Fed did something wrong. It's always the Fed. They always set the stage. They claim victory. Right now, they're claiming victory. They've slayed inflation. Okay, right. So I started this off talking about the yield curve because the last time I spoke about it was on Thursday, and believe it or not, that one trading day, a lot changed. A lot changed. So the yield curve, this was up like 0.7 on Thursday night. It spiked to 0.17 by the end of business on Friday. That is a huge, huge move on the yield curve. Now, for those folks that don't understand what this is. Don't worry about it. Don't worry about what it is. Worry about where it's going, what it's doing, and what the trend is, and what happens when you get an uninversion of the yield curve. Let's go to our monthly chart. I need to go over this and repeat it because I want everybody to be aware. It's very, very critical. It's one of our key components that we look at to identify, do we need to lighten up here? And as it stands right now, this is starting to signal raise cash, raise cash. Equities could still go up for all I know. Raise cash. Now, here's the monthly chart. Overlaid in black is the S&P 500. You go back to 2000, you get the uninversion of the yield curve in Candlestick. Equities roll over. Financial crisis, same deal. Steepening of the yield curve. Equities roll over. Huge crash. COVID. The steepening began before COVID hit. And once it hit, the equity market crashed. Where are we now? We're breaking out. We're not above the November highs yet, but this is one very bullish chart. The thing to appreciate about the yield curve is that it can unwind very, very quickly. So for those folks that are out there that are thinking that, the Fed has got this right, equities, you have the Qs breaking out to new all-time highs, Dow's broken out to new all-time highs, and that is bullish. That's extremely bullish. The problem is that there is a problem out there called the yield curve. It's telling you something. There's something wrong with the economy. How is it that the yield curve was able to pick up on COVID before COVID ever even hit? Think about it. The bond market is the best and brightest instrument out there. What else do we have here? This is kind of goes back to the geopolitical topic that we were talking about over in Yemen. We have missiles. For all I know, you want to fact check me on this, folks, okay? I do not want to be hyperbolic. I do not want to spread information that is not accurate. Fact check me here. For all I know, this is AI, but it looks as though we have our consulate under attack over in Erbil in northern Iraq, and those missiles are coming out of Iran. That's an act of war. Those consuls are U.S. property. It's counted as U.S. sovereign territory. So if you're wondering why gold and the dollar are rallying together, now you have an idea. Oh, here it is. I was completely out of order here. So this ship is probably at the bottom of the Red Sea right now. I hope there were no injuries. There was a picture, but they don't have it here, of it on fire. So Houthi militants attack U.S. container ship with ballistic missiles days after Biden attack on Yemen. So we know that we have geopolitical risk on the table. Normally, when you get that geopolitical risk on the table and or the economy going into a decline, you get disinflation or deflation. And you've seen, this is a monthly chart of CPI. You've seen the CPI come in quite a bit over the past several months. We want to acknowledge that. But the Fed target of 2%, we are nowhere near 2% on inflation. And we are not going back to where we were back in 2020. So for those folks that are out there that are hoping that they're going to see those heydays again, it's not going to happen. This, to me, looks as though we are setting up for another leg up. It's an orderly pullback over an overbought condition. RSI, look at how high we were on RSI. It looks as though we're probably going to spike up higher. Maybe it's not even this year. Maybe we just trade sideways. I don't know. I'm not that smart. But we're watching for the breakout, because if, in fact, we do begin to break out, that is bearish for equities, bullish for gold. Unless, of course, the Federal Reserve is back in tightening mode. And if they go back to tightening mode, that's an admission of failure, and they can't do that. They'll never do that. Twitter not loading, man. Food prices. We saw the agriculture prices have come in a lot. I showed you the price of corn. It's a 3-year low. But the price of a basket of groceries that cost $100 in December of 2019. Oh, okay. Now costs $125.51. Gotcha. Now I understand. So inflation at the food level continues to rise, even though input costs, even on cattle, have come in some. Very strange. Now, there's a prediction out there that the consumer, debt-saddled consumers are embracing even more doom spending. So the consumer is tapped. Most credit cards are at or near their breaking point. You have banks that are reducing credit lines. And what they're expecting, this is off of Shift Gold, what they're expecting is that the consumer, with one last burst of spending, because they're so in debt, they realize they're not going to be able to pay for it. They might as well just max out their credit cards before they file for bankruptcy or go into a negotiation with the bank to try to reduce the amount of debt that's outstanding. They did that back during the financial crisis. So that's the guess here, is that this is why I said earlier that we're going to have consumer spending coming out this week. There's a very good chance that we beat on that number. But if we beat on that number by a large mile, that's probably this prophecy coming true that the consumer's just saying, you know what, the heck with it. I'm not going to be able to pay off this debt. I'm going to max out my cards anyway. And it's not good. It's not good for the banks, that's for sure. And taking a look at debt by generation, I mean, the Gen Zers, their debt change over the past year has gone up 9.3%. This is a lot of money. A lot of these people do not work, yet they have all this debt. It's non-mortgage debt. So my guess, a lot of this is student, and of course, the credit card debt. Millennials, debt is rising. Gen X, phew. This is non-mortgage debt. And the average amount of debt that the consumer is holding is about $103,000, I believe it is. 16.84 trillion in total, a 4.5% increase. And it's at about a little over $100,000 per individual. Now, it's got to include mortgages. That's a lot of debt. So, on an individual basis, taking a look, let's go back to comments for a minute. We've seen crazier things here on the program before. Yes. You think it's fake? The missiles? It looks fake to me. Yeah, I didn't know if it was fake or not. I don't know if it's fake or not. That's why I just said it looked fake to me, but it could be a live report. So I just want to provide the news and just do your homework just before you take it and start talking to other people about it, which I should have done, but I didn't have time. But I wanted to get it out there. All right, so going into the new trading week, we want to talk about Apple. Apple very rarely cuts prices, and Apple in the largest market is cutting the iPhone 15, sliding demand. Now, Apple really hasn't come out with a gangbuster product since, unfortunately, since Steve Jobs passed away. It's been the iPhone. So when you take a look at the price action of Apple versus as a ratio chart versus the S&P 500, Apple is breaking down and breaking down very, very hard. This is not a dip that should be bought. In fact, I would go as far as to say that we have a double top. This is on a relative basis to the S&P 500. And we have broken down to lower lows. Technically, this is the low here. But we rebounded. We broke down to new lower lows. So I think that this setup here, I think it fails. And it could be that Apple goes down. Doesn't mean the S&P 500 is going to go up. It could mean that Apple goes down more than the S&P 500 goes down. Or S&P 500 can continue up, yet Apple goes up less. In short, it's a laggard relative to the S&P 500. That's the purpose of this chart. Fast forward to Tesla. A few days ago, Tesla cuts prices in China on Model 3 and Model Y EV vehicles. So they are yet again cutting prices over at Tesla. And how is their chart looking relative to the S&P 500? What's going on here? Tesla relative to the S&P 500 is a basket case. This is a confirmed breakdown on Tesla relative to the S&P 500. I would not buy this stock. Nor would I buy Apple stock. I think that right now their gooses are cooked. Add to this the fact that demand for EVs is not what they need to be. It's drying up. So I would avoid these two stocks going into the new trading week. Folks, I don't have much more time left. I need to go to the members area, see if there are any requests I need to go over. If not, we're going to call it a night. Don't forget to subscribe to our YouTube channel. We're doing the shorts now. Also, if you're new to technical analysis, I have a 5-part video tutorial down below giving you my free top 5 favorite candlestick patterns. Again, free of charge. Larry wants UNG. Franklin wants URA. Let's do it. Uranium and natty gas. Let's take a look. So weekly chart of nat gas. So I think what's happening here, Larry, is that we're doing a retest this week. Here's a 21 period EMA. That's right now at about 640 per share on UNG. I'd be looking for a pullback to that support level or even down as far as $6 per share on UNG. I would add or position there, stop loss right below that mark. Because if we close back down below $6 a share, that's a failed breakout. But right now, let's bring on after hours trade. They don't have it right now. They have grayed out. Let's go to a daily view. On a daily view, we hit a couple of resistance levels last week. No great shock to see a pullback. If we get a pullback to this fractal trend line, you could actually have a retest of around 575 per share. So tomorrow's probably going to be a bloody day for UNG. I would just watch for some bottoming tails, nibble early on. If you get a couple of days of consolidation and it looks as though we're building a base, then I would begin to add more, and especially more if we begin to add on strength. And if, in fact, we begin to break out above this resistance level here, ideally at around support level. If we break down below 640 early this week and recapture it by the end of the week and the following week, I'd be a buyer of nat gas. I would nibble down here. I would add more aggressively on a bounce back and a close above 641, 645 per share on UNG. Last one up for this evening is URA, uranium, which has been in fuego. Here is it. Wow, look at that move last week. If there's a retrace, it'll probably be down to $29.79. We may not get it. This looks like it wants to go up a lot higher. Do we have overhead supply? Not on a monthly time frame, not on a quarterly time frame, not on a yearly time frame. I think uranium is going a lot higher. Daily view. We do on a daily time frame have a little bit of resistance above up here at around 31.77. So we may get that retrace. Watch for 31.19 being a support level. In fact, I'm going to create alert. Keep a little bit of sensitivity. And we're good to go for the new trading week. So this is a rules-based approach. If this, then that. If we pull back to the support level, then we can open up a position, sell puts, buy a common, whatever. All right, folks. Thank you so much for being here. Everybody have a profitable trading week, and I will talk to members tomorrow morning. Till then, have a great night. Be well.